Welcome to TheoTrade. This is Don Kaufman here doing the weekend update on December 11th, 2016. First and foremost, let's start with a brief review of a little bit of the really upward mass movement in broader markets from last week. And then much more importantly, this week, we're going to be very forward looking. There's obviously a FOMC announcement coming out in the week ahead, and we're going to look and try to read into a little bit about what implied volatility says specifically about this FOMC announcement, which ultimately appears to be completely priced in, meaning the risk is actually priced in out there. So again, first and foremost, let's take a look at the S&Ps. This is, of course, the SPX, and what has been an astounding, and it can only be really described as an astounding move to the upside. If you're a trader, if you've been a trader for a long period of time, you know, it's rare to see moves that are this violent, of course, to the upside. And it's rare to see those moves in terms of even looking at an equity product. I mean, when I look at the SPX right now, this reminds me of a stock, you know, like something like NVIDIA and its recent charge to the upside. By the way, NVIDIA happens to look like it's topped out a little bit. NVIDIA like being this unstoppable beast. And then you have to realize, well, no, this is the entire S&P 500. It's the NASDAQ. It's the Russell over here exploding to ultimately new highs each and every day. So as a trader, instinctively, we look at this and we think, how do I take the other side without getting absolutely crushed in here? Again, it's kind of instinctual after, 17, 20 years of trading to look to the dark side of the marketplace. Can the rally really continue? Clearly, the answer is, for the time being, yes. There's one important lesson to be learned, though, in here, and it's something I've been reiterating for months and months and months. Now, early in my trading career, I built a trading career around selling options premium. And I got to tell you, looking at a move like this, I have been warning not to be on the sell side of options premium because, simply put, the premium that you're collecting isn't worth, right, the risk that you're experiencing. And how evident that is in recent weeks here. And for the most part, there's a, kind of terminology I use a lot, and it's the juice isn't worth the squeeze. And what I'm talking about in there is if you look at the SPX and you go and you glance at implied volatilities. Now, the implied volatilities are forward looking, and we all recognize what some of the risks of the market happen to be. But you look at these implied volatilities, and again, this is 16 days out and 12 days out and 10 days out. I mean, we're talking about 10 and 11% implied volatilities. It's again, it defies logic of why you would want to sell premium in the broader markets. And moreover, when you start to look around into individual stocks, and I'll bring up something like Google for a moment. You look at Google, and we'll just go out to the weeklies here. And all right, so it's a 17% implied volatility. Now, to some of you, that might not mean a tremendous amount. 17 vol, well, but that's the risk metric that's really pricing options. So when it comes to implied volatility doesn't care that this is Google. Okay. You look at it, okay, it's a 17% implied volatility. It doesn't care that it's Google. And then you compare the risk, and that's what the implied volatility really is. It's the risk 19 days out is like 17%. You compare that to something like Walmart. And you're like, Don, really? I mean, come on, Don. You're going from what? Google directly over to Walmart. Yeah, and their implied volatilities are almost identical. And it's something that really resonates with me is how much risk is out there. And when I say, I'm not a big fan of selling premium at these levels. Yeah, when Walmart's risk starts to become, equivalent to something, like Google, you have to start to question markets a little bit. Speaking of questioning markets a little bit, go back over to the SPX for a moment, and there was something that really stood out. I think a lot of traders did probably catch this in the previous week. So what was it? What really stood out to me? Again, in the explosive up move, we actually saw several trading days where the market rallied. And again, the S&Ps rallied, the IWM rallied, okay, which is the Russell, the NASDAQ rallied. in addition, the volatility went up. Now, you could look at volatility futures, neither here nor there. I know a lot of people are more comfortable with the idea of the VIX, but I'll show you that in several of the trading days this week, we actually had upward momentum with the S&Ps exploding higher. Now, that's almost, if you will, it almost defies logic, obviously, because, again, you're increasing implied volatility. That's increasing risk with the market going up. And again, that's indicative of almost like a panic buy mode that traders start to get into. And it hasn't been seen in a very, very long time, especially not 2 days back to back. And again, when you start to look back in time, all right, there's only been a handful of occurrences, especially where you have 2 trading days in a row where volatility increased with explosive moves to the upside. It's something to consider. Now, for those of you that are a little bit more astute into volatilities, the VVIX, which is the volatility of the volatility index, right, has actually displayed that traders have been buying implied volatility as of late. All right, so again, they're buying up volatility. Well, one of the reasons, though, can simply be it's not necessarily the market's not going to go higher. They could be buying volatility for the simple fact it's rock bottom right now. I mean, implied volatilities really are rock bottom. They might be coming in, scooping up a little bit of volatility. Nevertheless, it's to be considered a little bit of a warning when, again, markets are exploding higher and you start to feel like the market's getting a little bit frothy out there, if you will. Nevertheless, we still charge higher. One thing that did stand out in terms of Friday, the IWM, even though it did progress to new highs, finished the day massively unchanged for the most part. It was starting to lead earlier in the day and became actually the laggard as the day progressed over here. Watch the Russell very carefully this coming week, as it's been on the forefront of many of the moves we've seen. The Russell has exploded above and beyond our other major components. Now, here we're going to be looking at the NASDAQ, but there's a comparison that I've been using lately to display this. This is the Qs versus the Spider versus the IWM. I think it displays it, Really, it's evident when you look. Here's the IWM, versus the Qs versus the Spiders. And that's over the last 6 months. And taken even to a tighter time frame over the last 3 months, you see, ultimately, again, the Russell being on the forefront of this move and starting its ascent well before. Well, again, if it's going to be in completely and ridiculous overbought territory over there, is it going to come off first? We'll be watching really carefully this week. The thing you have to recognize about the Russell, it's also very, very interest rate sensitive, which brings me to the next point. There's a lot of stuff coming out this week. And I come over to the calendar. Probably the most notable, of course, is going to be the FOMC. Now, yeah, the Fed's going to meet. And most traders are really discounting, if you will, what the FOMC is going to do. A rate increase is being priced in right now. Plain and simple, there's pretty much 100% chance that they're going to raise rates. Almost everybody is expecting, of course, the 25 basis points, right? So basically a quarter point, raise in the rate. The impact to the bonds, well, wait and see in this neighborhood over here what the impact of the bonds. The bonds have already ultimately priced this in. But again, what speaks volumes to me isn't so much the movement in the bonds this past week, which again, I'll come back to in a moment. It's the fact that the implied volatility is inherently and incredibly low. So with 3 days remaining, this is a Wednesday expiration, and this is the day that the FOMC is going to have the announcement. The implied volatility is indicating nothing more than about a $21 move either up or down. Now, we've seen a lot of days. This past week, we had over a 30-point move to the upside on the S&Ps. And again, you're looking at implied volatility. It's rock bottom out there. It's not premium that I'd want to sell. And actually, if anything, this becomes an opportunity to trade, especially on an intraday basis, as the options in here are dirt cheap. I mean, again, you want to be what I would call long gamma this week. And that ultimately means you'd rather be a buyer of premium when the volatility is rock bottom. I mean, you think to yourself, you sell premium, nothing good can happen to you. If you sell options premium, sure, the market might move your direction, but volatility being rock bottom can't really go any lower. I mean, if you're lying at the bottom of the pool, can't really go any lower, right? The only place that implied volatility ultimately goes is higher, and that's not going to help you if you're a seller of premium. Again, with volatilities this low, I'd rather be what's called long gamma, long premium out there. So keep it in mind throughout the course of this week. Now, the FOMC, again, everybody, it's all priced in, it's all priced in. Well, not only is there an FOMC meeting and the announcement, but there's also, of course, the press conference. All right. Now, I know there's going to be a huge amount of conjecture around this, and the media it's a mass media event. Okay. From where I sit, there's only one thing that the FOMC can do. The FOMC is clearly looking at the S&Ps, obviously a little frothy. They're also seeing what's going on in the bonds. The bonds are getting decimated. And their concern isn't so much the bonds as it is, right, the 10-year Treasury index, which right now is approaching roughly 2.5%. Now, this is the interest rate associated with the 10-year. This is getting to dangerous levels. If the interest rates continue to explode higher, obviously it can put the brakes on the economy. So really, I think what this press conference is going to do and what the statement out of the FOMC is going to do, sure, they're going to raise the rates. And sure, they're going to put it, that 25 basis points up there. But I think their statement may throw some people a little off guard because it'll probably be a very dovish statement. And that ultimately means I think that the FOMC at this point would want to talk rates back down a little bit. We start getting north of 2.5%, things could get serious in a hurry out there in terms of cooling off all the work that the FOMC has done, okay, since 2008, 2009, when rates hit zero. All the work that they have done can be undone by ultimately this interest rate exploding just a little bit higher. Really prohibitive levels come into 2.7%, 3%. Again, literally slams the brakes in the economy. So my expectations will be a little bit dovish. Now, that could actually mean a rally back up for bonds. So we're going to watch bonds very, very carefully. They've been driving a huge amount of the market. Again, capital flowing out of the treasury markets back into the S&P 500. All right. And ultimately, the bonds really closing very, very close to multiple year lows here at the 148 level. And again, to show this in full view over here, it's multiple year lows. Again, that's a 3-year daily you're looking at inside of the bond market. Again, bonds, be on the lookout. Now, overall, during the course of the week, there's a few things I want to caution as well. This is, right, a quarterly expiration, which entails the SPX options with 4 days. Now, again, the last time you can trade those things is going to be Thursday night. They go off of the opening, right, settlement price of Friday. I myself do not trade. I no longer trade the monthlies in the SPX. I'll only trade the weeklies. The weeklies are PM settlement. The monthlies, okay, are what they term AM settlement. I don't need no AM settlement out there. Now, when you look at that, there's still 3 expirations throughout the course of the week. Nevertheless, to get a feel for the entire week's, okay, expected move, look at the 5-day options inside of the spiders. And the spiders, the 5-day options, they're indicating a $3 and about 30-cent expected move. The reason I highlight this, just convert this for the S&Ps. We're looking at about a $33 move higher or lower this week. Again, which is on a relative basis low. So the FOMC meeting, there also happens to be a Bank of England meeting coming out on Thursday morning. So you've got a lot of news, okay, and a lot of catalysts that are going to drive a bit more risk as the week progresses over here. Hence, you have about a 14% implied volatility. This is also thought of as like the last, what could be really intense trading week of the year. After this, it's all over but the crying, right? We're pretty much into the Christmas season. And again, we're going to get into some holiday trade. So this week, expect heavy volumes out there. Option volumes have been ranging about 20%, okay, above norm. 20% above norm in terms of volume on options contracts over there. There's a lot of risk floating around with the recent rally up. Keep all of this in mind this week. Keep on guard. Again, I don't like how low the implied volatilities are. Okay. Obviously, we've had this, explosive rally to the upside. If there's products you really want to keep your eye on, obviously the Russell, but even more importantly than that, and last but not least today, you got to look at the financials. In terms of a sector, on a percentage basis, it's been nothing less, again, than an astounding move inside of the financials. Now, the financials, well, they make a little bit more sense this week. If you open up their 5-day options, people, they're sitting at almost a 30% implied volatility. Now, behold, why am I talking about the financials and their implied volatility? I'm going to leave you with this thought. First and foremost, there's wild amounts of open interest, even in the 5-day options over here. Again, this is the major quarterly expiration. It's known as the triple witching. Neither here nor there, but a lot of risk is going to be coming off the board this week. A lot of people are going to be positioning themselves, rolling positions out, okay? But there's almost 30% implied volatility. And you have to recognize, a little while ago, we looked at Google. It's almost double, okay, Google's implied volatility out there. And you start to realize, wait, this isn't an individual stock. This is the entire financial sector. Expecting, all right, almost 70-cent move on the week. Obviously, the XLF, the product to watch over here. And again, when you start looking at things like implied volatilities, it'll give you a new feel for the marketplace. And that's this. We looked over at the SPX a couple of moments ago, and I'll leave you with this thought. And the SPX throughout the week is, about a 13% implied volatility. All right, so there's a little bit of risk in the markets, yada yada. Obviously, we see a lot more risk inside of the financials because they're going to feel the brunt of the impact from the FOMC. But I leave you with this in the TLT. If you look at the bond market, okay, the bond market implied volatility is higher than Google. All right, again, it almost doesn't even comprehend when you start to look. Oh yeah, the bonds have become riskier now than individual stocks. And things in markets are getting a little crazy when, right, the market itself is placing more risk in the U.S. Treasury market right now than they are not only in just individual equities, okay, but they're placing more risk in the U.S. Treasury market right now than they are inside of the S&P 500. Something to think about as the week actually progresses over here. Keep your eye on the bonds. They could change the way you feel about markets very quickly. Thanks everybody for joining us here at TheoTrade. I'm Don Kaufman. Be back on in the TheoTrade chat room all throughout the course of this week. Have a great weekend. Bye-bye.